So, what is the best strategy to pay for large capital expenses like college or cars? And please remember, a large capital expense is something that you can't afford to pay in full with one paycheck. And certainly, college is one of those expenses. So, after 20 years, I have been teaching a concept. You can call it the wealth builder concept, the banking concept. But in essence, what this concept is it's how to use a properly structured dividend paying whole life insurance policy to pay for large capital expenditures. There are significant benefits to doing so, and I'm excited to share exactly how and why we would use cash value life insurance to fund a large capital expense. I like to call this concept the wealth builder strategy. And really, what it is, the vehicle that we use is this properly structured dividend paying whole life insurance policy from a mutual life insurance company. Now, what you need to know is whole life insurance has been around for a very long time, hundreds of years. And the way we engineer these contracts today is we allow clients to stuff lots of money into them while maintaining a smaller death benefit. So we get all the living benefits of this vehicle. Now, I hear it all the time. Oh my goodness, cash value life insurance, isn't that a bad thing? Well, the reality is many people are using this wealth builder strategy or a properly structured dividend paying whole life insurance contract to create wealth for the future while they're paying for expenses today. Bank owned life insurance is a properly structured whole life insurance contract. And they're the number one, banks are the number one purchasers of this type of insurance, cash value life insurance. Again, the product's over 200 years old. Banks own more life insurance than land and buildings combined. So, how do we use this whole life contract, or why would we use? Well, the first thing is because the cash value that's inside the policy is actually guaranteed at 4%. Now, most insurance companies are paying dividends, although they're not guaranteed. And when you choose a life insurance company, I highly recommend mutual life insurance companies because we're mutual owners. So we receive the profitability of the company in the form of a dividend payment. But of course, that profitability is not guaranteed. Now, dividends for the life insurance companies I work with have been paid well over 100 years and never missed. So when you add those up, current dividends for top mutual life insurance companies are running around 6%. Once the money gets into the cash value portion of the insurance contract, it grows guaranteed, uninterrupted for the life of the contract. We do have access to this money, so we can use the money to pay for college or cars or large expenses, and ultimately a tax-free income. You have control of this money. If you need access to the money, you can get it. There's significant tax benefits in a cash value life insurance contract. One is the money grows tax deferred. And if you borrow it out correctly, there are tax-free distributions. On top of all of that, there's a death benefit. So in case you meet your maker early, your family is protected. And if you live to life expectancy, you will be able to leave a legacy. This is how a properly structured whole life insurance contract works. We make premium payments or deposits into the cash value life insurance. The cash value is guaranteed. It pays dividends. There's uninterrupted compounding interest. It's liquid. You have control, tax-free, and death benefits. Now, when the time comes to use the money, the mutual life insurance company that holds that life insurance contract, they're going to look inside of your cash value contract and they're going to see how much money you have. They then will give you a loan. The life insurance company actually gives you their money. They do not give you your money. That allows your money in your contract to continue to grow, compounding uninterrupted every single year. Now, the interest is going to be, or there is going to be interest charged. The insurance company is going to charge you interest. But remember, your contract is earning interest compounding. Now, the loan rate and the dividend rate might vary, but historically, there's always been a positive difference between what your money is earning in the contract and what you are paying. Now, the loan repayment of the life insurance contract is very flexible. So you can choose to pay that contract or pay the loan off in interest only, monthly payments, large lump sums, or never. Because what the insurance company knows is they will get their money sometime because a death benefit is associated. And if at death you still have a loan, the death benefit will pay off the loan first, and then the rest will go to your estate income tax free. Myself and my clients have been using properly structured dividend paying whole life insurance as a safe holding place for our money that we can then repurpose to pay for large capital expenses for almost 20 years. I personally have 15 whole life insurance contracts that have helped pay for many things over the last 20 years: cars, houses, real estate, college. So I have vast experience at setting up these properly structured whole life insurance contracts so that they can add significant value to your family's wealth, not only today and in the future. If I can help you by answering any questions, I would welcome the opportunity to do so. You're also welcome to sign up for a 1-hour free consultation with me so I can help you understand your current financial situation and how a product like this might add value to you and your loved ones. Thank you so much. Have a great day.